Hi, this is Perrin Cornell with Coldwell Banker. First of all, pardon me, I've got a bad cold, and it is a cold, and it just settled in my throat, so I really don't have much of a voice. But that could be a good thing. I won't talk too much. Today I'm with Clay Schoengarth of Supreme Mortgage, right, Clay? Supreme Mortgage?
Supreme Lending.
Supreme Lending. Okay, thank you. I've known Clay for probably, maybe better part of 20 years. He used to be a lender with Wells Fargo and then with a couple other companies. I spent some time, I think, didn't you, doing reverse mortgages too?
About 4 years doing reverse mortgages as well, yes.
Yeah, so as far as that concerned, Clay's probably a guy that can tell you more about mortgages than most of the people around. And why don't you tell us a little more about yourself, Clay?
Okay. Well, I've been in the mortgage industry for about 25 years. I've carried multiple roles. I started my career as a processing assistant, worked my way up, eventually got into the secondary markets where they buy and sell and trade mortgage notes and securitize them with Fannie Mae, Freddie Mac. And then basically for the last 15 years, I've been an originator here in Wenetchee Valley. Some of those years I spent with reverse, but mainly I've gone back to my roots as just your home loan lender.
All right. I typically work with about 3 lenders in the area. There's a lot of them around, but I typically work with 3. And in my opinion, they're the 3 best in the area, and Clay's one of those 3.
Thank you.
Well, you deserve it because we haven't done a lot of business recently because things were kind of going different ways. But anyway, Speaking about things going different ways, if we were doing this last year at this time, we'd probably be at 2 7/8 mortgage rates.
Yep.
Where are we to now? What's going on?
Well, that's the big subject right now, Perrin, is rates and what's happening. Rates are in the 7s. They're in the low 7s without buying discount or buying down the rate. Really, the big driving force behind that is the inflation. Rates will always follow inflation. And until we get the inflation under control, rates will remain where they're at. We have a little bit of a glimmer of a hopes coming in November. I believe it's November 10th, when the core CPI report comes out, and that measures inflation year over year. And looking at the inflation year over year, we're anticipating that we may have a little bit of positive news. Now, are rates going to drastically reduce or drop? No, I'm not saying that at all. But we may be on the right track. We may be at the worst of the worst, and hopefully at the top of the hill.
I pretty much go along with you on that. Last spring at this time, I was talking about a rate around 8% this time of year. It's not there. I hope it doesn't get there.
Right.
So, and then I've been looking at some stuff. I saw a report out of Morgan the other day, and they said that at this point in time, this is the largest they've seen where people have cash parked on the sidelines. They're not in the market. They're not in bonds. They're not in stocks. They pull the cash out and they're holding it. And that actually looks pretty good because eventually it's got to go someplace.
Right.
That could be a positive thing. So a thought, and I'd like you to comment on it. If you look at buyers are saying, with the rates so high, we can't afford to buy. Well, there's some truth to that.
Right.
But if you look at it from the standpoint of prices today are coming back to where they were probably a year ago, and they're not there yet, but I mean, they're moving in that direction. So basically the prices have started to slow, and in some cases actually coming down. So a 7.5% rate compared to what you could have bought a year ago is, you see what I'm trying to say? Yeah. I'm not doing a very good job.
I think there's a couple things to look at here. I think I still think it's a good time to buy, and really the reason why is it is not, the sellers don't hold all the cards anymore. They're in more negotiation. There's more inventory. You're not paying $40,000-$50,000 over asking price that you were maybe 6-7 months ago, and prices have come back down. So the rate, yes, it does hurt, but it is kind of an oxymoron because you've got more of an opportunity right now to own a home. And as soon as rates do come down, and they will, what's going to happen is everybody's going to come back into the market. You're going to see appreciation again, and then we may even see the competition come back.
Yeah. And also when rates do come down, there'll be a raft of refinancing. There always has been when that kind of thing happens.
That's true.
But there's some options you can do as a buyer that might mitigate the rate a little bit, like what, an arm?
Yeah, I mean, so the arms in the adjustable rate mortgages, I'm not gonna say that's a great option right now. There are some banks and some credit unions that have their own proprietary product that may have a good arm, but most lenders out there don't have access to them. The reason being is that short-term rates, well, you see the Fed's raising the rates every time. Those affect adjustable rate mortgages. They do not affect long-term like the 30-year fixed. They may indirectly affect them, but not directly like the adjustable rate. We're also seeing an inverted yield in the market right now. And so short-term loans, which is the adjustable rates, are not doing well. In fact, they're really close, if not the exact same as a 30-year fix. Same thing with the 15-year. There's really not much benefit in a 15-year. But what the buyers can do, they can negotiate. Now, the seller can pay your closing costs. They can also pay discount points. So you could negotiate, if the seller's willing to, negotiate the seller to pay your closing costs, plus some discount points on top of it as well, so that you can bring down that rate and buy a lower rate. There's also options of not just buying down the rate permanently, but you have what they call 2-1 buy downs or 3-2-1 buy downs. So those are also options as well. For example, a 3-2-1 would be, it's 3% less the note rate the first year, 2% less the note rate the second year, 1% less the note rate the third year, and then the fourth year it goes back to the normal note rate.
And if you put that back into the scenario back in 2007 where things went sideways, by the time you're in that fourth year, the rates, everything had started to change.
Yes.
It's possible to refinance and possible to have a little bit better rate. That's a good point.
Perrin, I do think, and you may not be in agreement with me on this one, I do think that rates are going to drop sooner than later. You know, I think that we're seeing drop in here within the next year, possibly even Q1 of next year. As soon as we hit a recession, which some will argue the fact, but I see it's inevitable that we're not going to hit a recession. Once we see that recession, rates will start to drop as well.
Correct. Yep. Actually, and I agree with you. I'm pretty firm that it's probably going to be sometime late in the first quarter, if not a little bit before. You know, first of all, we started the year with 5 million, needing 5 million homes. Builders have slowed. We still need 5 million homes. We started the year with, let's see, back in 07, we were selling like 1.6 million homes. We're down around 1.2, 1.1. So there's a heck of a long ways they can go as far as selling more homes. There's more inventory. Well, let me share my screen a second here and get something in for all of us, I think.
You had mentioned inventory, and that's the biggest difference between 07, 08 to now. I mean, we had 3 to 4 times the amount of inventory back then than we do now.
Yeah. Let me see if I can find one. Oops, I went the wrong place, but this will do it anyway. I don't know if these are going to come up in the right sequence or not, but we'll see. Okay. All right. This kind of goes along with it, and they're a little bit out of sequence, but it'll get to where we're going. This shows the showings to pending over the last 2 years, 3 years. And if you notice in this area where things were really going hucklebuck, you know, back here at the end of 2021 and the first of 2022, you're only getting 2 or 3 showings before the house went pending. That's because there was nothing in the market, you know. We're up around 8 now, and it looks like it's still going to go higher. So that's one thing to think about. Now, if this works the way that I think it will, and it doesn't, so we'll just do it this way. We'll go get another one and we'll try.
I like that slide. I've not seen it before.
I'll send you a copy of it. Here's the median sales price. And this is where I was going a little bit ago. It really hasn't declined all that much. It's a slower curve in here. It's a slower curve here. I'll do it that way. Slower curve in here than, you know, it was like down here. Right. But it's still pushing up, and it's well, just a little shy of, just a little over 450. Yeah. And by the way, I did this on a local area. I used 988. Well, I used Wenetchee and East Wenatchee, Malaga, and Rock Island, and Sunny Slope. So that's kind of this is our area, really. Okay. And then let's take a look. I think this is the one that'll tell us. Now, talking, here's what's going on. This is average of list price. You mentioned about where prices were. Well, that's where they were. 102, almost 103% of list price. And that's original list price, by the way, not a revised list price. Now they're down just right at 100% of list price. So basically that tells me that sellers are getting what they want. Buyers are getting a better price than they would have.
Right.
And you go back and you look at the number of showings, and it looks, I think it looks pretty positive for us.
I do too. I do too. And I had to ask myself the same question this year. I went to go buy a house this year, and I asked myself this exact same question: Is this the wrong time to buy?
Yeah.
And really, what it came down to is this is a long-term investment for me. I'm not flipping it. I'm not selling it in 2 years or a year, and I know I'm going to be in there for 5 to 10 years, and so I just got to go ahead and buy.
Yep. I got one other here. I think this is it right here. Come on, open up. There we go. Okay. I got this the other day, and this is what fellow was writing as to why he thinks that the market ain't going to go to hell and will turn around in the next 6 months. Inventories are rising. Builders have slowed their production, so they're not like in 2007. They're not caught with hundreds of homes sitting on the market. Inventory increased last time. Well, it's not. We're doing fine there. Unemployment peaked in October 2009 at 10%. We're at 3.5%. That's a big difference.
That is a big difference.
Homeowners owed more on the homes than the homes they were worth. They had no equity. I've got a little program that I use that I run it periodically for that same general area, and the average equity in a home is somewhere north of $50,000 to $100,000. In fact, and I can't remember if it's in here or someplace else. Oh, someplace else I was reading that back in 2007. Let's see. Back in, I got the note here. If I can just figure out what I wrote down. Okay, back in 2007. 80% of the mortgages that were made just before the crash were adjustable rate mortgages. It's only 10% now. Back in 2007, let's see, back in 2007, the average homeowner had no equity in the house. Today, the average home has 50% equity. I find that hard to believe, but if you look at the way things escalated over a couple of years, you can be there. And if people have equity, they've got rooms to work with stuff, make things happen. Let me see here. Is there something else where'd my mouse go?
You mentioned the inventory increase last time, and you're right. The builders did not stop back then. And I think the reason you're seeing some of the builders pull back now, and they are pulling back, is because they've learned their lesson in 2007, 2008, and they're a bit scared.
Yes.
Which therefore, it drives appreciation because now there's less homes to buy.
Yeah. Well, and this right here, I ran into this one the other day. You can rent a home in your neighborhood for a smaller monthly payment than you could back in 2007. Today, a smaller monthly payment than a mortgage. Today, you can't do that.
Yeah.
They're way over. I have a builder that I'm working with, and he's got a house that he hasn't sold, and he's arguing with me about the price. And it's mid-5s. And he just rented it out $3,700 a month.
Wow.
Yeah, 500. Even 100% $500,000 loan, $550,000 loan. You're not close to $3,700 a month.
Wow.
And then this one surprised me that the inventory has risen dramatically this year, but it's still lower than the inventory of 2018, 19, and 20. And 18, 19, and 20, we had plenty of inventory, and we were able to do the stuff we needed to do.
That's right.
So, well, hey, we just about ran out of the time I told you to take. I told you I'd only beat you up for about 15 minutes or so. once more, how do we get hold of you and where and how about all that stuff?
Supreme Lending, we're right across from McDonald's on North Mission, right next to Chipotle. My phone number is 509-264-7102. And I'm here for any questions that you may have, or you're looking to get pre-approved.
Okay, again, your final phone number is 509-264-7102.
That is correct.
Clay Schoengarth.
Correct. It's a hard
Hey,
one.
buddy, good to see you.
You
Thanks
too,
for
Perrin.
taking the time, and I'll pass you a copy of this.
Thank you for having me on.
Hey, my pleasure. Thanks again.
Hi, Kristen. You better do that again. I missed the first part. There you
Hello,
go.
welcome.
Thank you very much. So how's your open house going?
Very well. Great day yesterday. Another great day today.
Good.
I believe we're going to get under contract.
Couple of offers, yeah.
Couple of offers.
That's
already on the
terrific.
table.
That's
Yep.
terrific. Well, the house looks great, and I know our other open houses have been going well too, so thank you very much.